Now, even though a low-interest auto loan is a good type of credit, in the first year the auto loan is open, it is considered new credit, which slightly drops that 10% of your score. The new account also negatively impacts the 15%, which measures length of credit history. However, after the first year or two of payments on that auto loan, it will no longer be considered new credit and will begin to reflect the benefits of a more mature account. Keep in mind that to get the most possible benefit from the length of credit history factor, an account must be open and active for 10 years or more. As you can see, our auto loan will be completely paid off in 5 years, and then will no longer be considered active. Since inactive and closed accounts do not contribute to your credit history, this 15% will not benefit much from most installment loans. The 30% of your score that measures amounts owed takes a significant hit when an installment loan is first opened. This is because the beginning balance of an installment loan, like our auto loan, is usually at the maximum balance, putting our debt ratio at 100%. The good news is that as we begin to pay down the balance on our car loan, the ratio gets lower and lower, which helps this portion of your score. Unfortunately, this takes time, and once the account is completely paid off and closed, it no longer contributes recent activity to our score, and after 7 years it will drop off your credit score completely. So with an installment loan, we get some benefit from this 30% section, but also some negative activity as well. Last, the payment history factor is very simple with installment loans, like our auto loan. If you simply make all your payments on time, this factor builds positive credit history. However, once the auto loan is paid in full, there is no longer any positive payment history being added with our auto loan. Keep in mind that with any loan, only a few missed payments or late payments can result in a significant drop in your credit score. That's because this is the biggest factor of all in a credit score. Making timely payments is the foundation to building a good credit score. Installment loans are a much better choice than finance company loans for building and keeping a good credit score, but they still have their shortcomings. The major shortcomings with installment loans, in summary, are their initial high debt ratios and their short loan periods. Another major shortcoming besides those already mentioned is that lenders usually only give installment loans to customers who have already established a decent credit score. If you have no or poor credit history, it can be very difficult to get any type of reputable installment loan. Now let's take a look at the last type of loan, called revolving loans. Revolving loans are open-ended loans. This means that you can borrow any amount of money you choose at any time, as long as you don't go over the maximum available amount. If you pay down the balance on these types of loans, you can go right back out and borrow some more without so much as a phone call to your lender. Examples of revolving loans include credit cards, department store cards, and personal lines of credit. To get your first revolving loan, you can start by applying for a credit card with a low maximum limit. Most national credit card companies are willing to take a small chance on people with no credit by offering high-interest cards with low maximum limits. But in some cases of no or poor credit, you might not be able to get a traditional credit card. Now, the good news is that there still are some other options for people in this situation. For example, using a co-signer can sometimes qualify you for a loan when you cannot qualify on your own. A co-signer is someone who adds their name to your loan and agrees to become responsible for your debts if you don't make timely payments. This is a good deal for you, but potentially hazardous for your co-signer because he or she will be on the hook for your spending if you don't make the payments on time. In short, it can often lead to strained friendships and family relationships, so it may be wise to avoid this option. A third option is to open a secured credit card. A secured credit card requires that you give the credit card company a lump sum of cash that can be used as collateral against any charges you make on that secured card. For example, let's say that I open a secured card account with a $300 limit. I would first have to come up with the $300 to place in the card account as collateral. Then I could go out and use the card for purchases. And if I ever failed to make payments on my loan, the bank could then take the secured money and pay the balance. It's very similar to using a debit card, only a debit card will not build your credit, while a secured card can. Even though you have money in your secured account, you never want to be late on a payment because this will still count as negative payment history on your credit report and will drop your score instead of build it. Now keep in mind that lots of people get into trouble with credit cards by spending more than they can afford to pay back. The key way to use a credit card is to use it only once every month or two, and only use it for relatively small purchases like a tank of gas. This may not sound like enough activity to actually build a good credit score, but believe it or not, this is one of the best ways to build your score. Here's why. First, since a credit card or other revolving account is considered a good type of loan, it contributes to the types of credit used factor. As with installment loans, when the card is brand new, it will slightly drop your score and reduce your total length of account history. However, unlike installment loans, you can keep revolving accounts open forever. This does something very positive for your credit. It reduces the need for new loans, and as your credit card account matures, it begins to add significantly to your length of credit history factor. A revolving account that is 10 years old or older is considered golden, which maximizes your benefit from this factor. Amounts owed is affected by your current balance compared to the maximum potential balance. Some people who get a credit card can't wait to go out and spend the maximum amount. Not only is this expensive, but it can also harm your credit score. A much better strategy is to always keep your balances low. If I use my card to pay for a single tank of gas every month or so, I will maintain a low balance of about $30 to $60, which is about 10 to 20% of the maximum possible balance on a $300 limit card. A consistent low balance like this is the best possible way to get the full benefit to your score from this factor. This essentially shows the credit scoring agency that you have the ability to borrow a lot of money, but you have the self-restraint to use only a small portion of it. Keep in mind that I can pay those charges off by the end of the month or grace period, and I won't have to pay any interest or finance charges. It is a myth that I have to carry a balance from month to month and pay interest on a credit card in order to build credit. Last, payment history is very easy to keep up with. Since our balance is relatively small, we can pay it off each month, and it is relatively easy to build positive payment history with a revolving account. Out of all three types of loans, revolving accounts or credit cards, if used properly, are the only type of loan that can maximize all 5 factors of your credit score. Plus, they are the only type of loan that can be used and paid in full each month so that you can avoid paying interest charges while still building your credit. Even if you never use another type of loan like an installment loan, you can still build a good solid score by properly using a few revolving accounts. So there you are. Not so tough, is it? In summary, you should always avoid finance company loans because they will not build your credit score and are extremely expensive. Installment loans will usually build mediocre scores and can be expensive due to monthly interest charges. And finally, revolving loans have the highest capacity to build your credit and can be virtually free of interest charges if used properly. As you begin building a higher credit score, you will see some remarkable benefits like reduced insurance premiums and loan costs, as well as increased opportunities for buying and renting a place to live, finding utility and professional services, and even better opportunities for employment. I wish you the best of luck as you begin building your credit.